Welcome back to Turning Hard Times to Good Times. I'm your host, Jay Taylor, and I'm really pleased to have Kevin Duffy with me today. Kevin was on, I believe, once before with his partner, Bill Lagner. Bill and Kevin run the Bearing Fund. It's a hedge fund that did extremely well during the financial crisis in 2008, 2009. Has not done as well over the last 6 years or so during the bull market. And, one of the things we want to talk to Kevin about today is, we're using and applying an Austrian model, a business or economic model. Where did some of us, including yours truly, go wrong over the last number of years? We've had this tremendous tripling of the stock market, and we've, and the things that are held near and dear to the lovers of free markets, honest money, for example, gold and silver, didn't do very well at all. In fact, we've had some pretty horrific markets over the last couple of years. But in any event, Kevin and Bill humbly acknowledge that things have not gone as well over the last 6 years as they did during the financial crisis. And what we want to do with Kevin today is examine some of the reasons and some of the flaws in the thinking, perhaps, and then use that as a way of preparing ourselves as best we can for what might lie ahead of us right now. So welcome, Kevin. I'm really glad that you could join us today.
I'm glad to be here, Jay.
Always good to talk to you. Bill was on just recently and did a great job. He always does, and the two of you make a terrific team. This radio show has prided itself and indeed has marketed itself as a champion of Austrian economics. And my first show was back on March, second or third week of March in 2009, which was just about the bottom of the bear market of that tragic decline, 2008, 2009. And since then, I've been continuing to champion Austrian economics. I still believe in Austrian economics, the very basic premise of malinvestment and the notion of that you need honest money and you send false signals to the market by printing money and all the things that Austrians hold near and dear. Timing is another issue, of course, but in any event, we want to examine questions that you recently raised in a speech that you gave, and that was the title of that speech is "Where Did Austrian Economics Go Wrong the Past 6 Years?" And you noted to me, in a missive you sent to me, the economy recovered seemingly, unemployment fell, supposedly, and bailouts were supposedly effective in stemming this horrible experience we had 2008, 2009. But you mentioned that even worse than that, for those of us who practiced and tried to apply Austrian economics to the market, Austrian investing in gold stocks and short selling, those kind of things, strategies were decimated. So we want to find out, what went wrong, what have we learned, and does Austrian economics apply today, or is it just some goofy idea that some Austrians come up with years ago? First of all, let me ask you: do you think that to what extent do you think the economy really has recovered, Kevin, since 2008, 2009? I mean, you get sort of conflicting ideas about it. The mainstream, of course, is championing the policies of the Federal Reserve, and but we talked to John Williams and some other people, and they look at the economy and say, well, wait a minute, the employment picture really isn't as rosy as the mainstream suggests, and prices are really higher than the mainstream suggests. But what is your sense of it? How real has this economic recovery been?
Yeah, I think if we go back to the bailouts, and at the time probably 70-80% of the people were opposed to the bailouts, and so there was a sense that that intervention would not work, that it should not be allowed to take place, and I think there was some skepticism among the people. For them, it hasn't worked out so well. For the true believers, it's worked out extremely well. Those that were running money, those that believed in central bank intervention. So the asset economy has done exceptionally well, and the real economy not so well. As my friend Mike Polaro likes to point out, the economy today is really the asset economy. So when that rolls over, when these asset bubbles start to burst, I think we're going to get a real good sense for what the economy looks like.
Mm-hmm. You know, we have this hugely leveraged global economy, with malinvestment. We think of malinvestment in China with the empty cities and the bridges to nowhere. Of course, it's also true in the United States and around the world because we've had this sort of statist economic policies, Keynesian economic policies, print money, go into debt. This is really what the whole world seems to believe in. And so we've had, the U.S. spends trillions of dollars for weapons to kill people and take over their countries and try to establish its own ideas around the world and its, control of markets, whatever the motives are. So with all this debt, it's my view, Kevin, that we are likely to see an implosion of the markets, of the equity markets, of these asset markets that you just referred to. On the other hand, I think most Austrians believe that we are probably heading inexorably towards some sort of hyperinflation event. I think of, the likes of Peter Schiff, for example, very well known. What are your thoughts on this? Are we likely to see an implosion and then an explosion, or what do you think might happen? What's your best guess?
Yeah, and I think we can go back to 6-7 years ago and try to answer that question, and then try to answer it today. Today, I believe that it's a little bit easier to answer, and I think part of going back and reflecting on where we went wrong 6 years ago, it was more of a blank slate. The amount of central bank balance sheet inflation was unprecedented, and we just didn't know. I think maybe the mistake that we made as Austrians back then was thinking we knew more than we knew, and thinking that monetary inflation would predictably do certain things. I mean, we know it does bad things, but the path that it takes, I think it fooled everybody. I think we kind of split into two camps, as you mentioned, the deflationary bears and the inflationary bears, and I think to a certain extent we've both been wrong. Today, with the asset bubble and with these stock market bubbles going as far as they have, number one, it seems to be long in the tooth. But I think also every bubble, and I mean, if we go back and look at we've had 3 bubbles in 20 years. Every bubble has its own underlying theme. The technology bubble had the infatuation with the new economy and the internet. With the housing bubble, it was the idea that real estate never went down. You could have some regional downturns, but you could never have a national real estate bust, and that we could essentially lever the home. This time it's the idea of stimulus, that we can stimulate our way out of these problems, and I think China was the big player at the margin. So the fact that China blew their bubble, and they've had a series of bubbles, and now that is unwinding, and really the commodity bubble peaked in 2011. This is already starting to play out. So we think that with each of these bubbles, there's an underlying theme, and the marginal cracks start to appear in sort of the marginal areas where the worst levels of malinvestment took place. And we're already seeing those. They're already very well advanced in terms of China. I mean, the commodity demand and the commodity bubble peaked in April, May of 2011, and here we are 4 years later. If you look at the last bubble, the housing and credit bubble, it was the house. Real estate started to decline in the first quarter of U.S. real estate started to decline in the first quarter of 2006. Well, the broad stock market didn't peak until really late 2007. So that's why those are several reasons why we think we're headed towards a more of a deflationary bust at this point.
Mm-hmm.
Now, having said that, after the bust, we do believe that that gold will have its day, and that there will be, we could have a give up in the currency, a collapse of fiat currencies, and all the things that the inflationary bears are talking about. But first things first.
Okay, so most immediately you think we're likely to see a deflationary, let's say, using the term deflationary, of course, is troublesome to Austrian economists. Let's say a price deflation or not necessarily a monetary deflation.
Correct. And really what we're talking about primarily is we could
an asset price deflation.
An asset deflation, and you could have a price deflation, and a wage deflation. You could have all these things, a debt deflation, alongside of a monetary inflation.
Mm-hmm. Sure.
Okay.
Yeah, indeed. I think, in thinking back of John Exter's work, that pretty much is what he had always been predicting would happen. He couldn't have imagined, I'm guessing, that we would ever see an asset balance, a central bank balance sheet exploding as this one has. But that was always John's premise, that's where we would go. And I think he was pretty much an Austrian economist. He definitely was a personal friend of von Mises himself, and they apparently had arguments about this from time to time, from what I understand. And Exter's son-in-law, who I know, in any event, as an aside. All right, so is Austrian economics, Kevin, these ideas of malinvestment and the things we talk about all the time, is this just pure baloney? It doesn't apply anymore? Or where did we go wrong here? Why did those of us who steadfastly adhered to the favorite asset classes of Austrian go wrong?
Well, I think, let's start out with, first of all, as a group, Austrians really nailed the housing and credit bubble. And so maybe we suffered from a little bit of overconfidence. But then I think we split into these two camps, and perhaps one of the mistakes that was made was the thinking that this was predictable, that the path that the monetary inflation would take, that it would naturally go into price inflation, and that would then translate into higher gold prices. And I think really the defining moment came down to the commodity boom from 2010 to 2011, and China. Was it real? And was the demand for commodities real and sustainable? And was the price inflation that was showing up in commodities, was that real? Or, and this is essentially, I think, what a lot of the inflationary bears were arguing, or was it malinvestment? And that this was not necessarily confirmation that the price of gold would be going up. And I think this is what the deflationary bears were arguing. Right now it looks like the deflationary bears at least got that part of it right.
All right, so China, the cracks that you're talking about in this bubble occurring in 2011, of course, we've seen that. Those of us that were invested in gold shares and commodities in general have really suffered since then. Why, the Keynesians, of course, and we think of Paul Krugman and those kinds, are suggesting, well, we just didn't do enough. I mean, this is always the argument. The argument was always, in the 1930s, it didn't work. Stimulus did not work, but hey, we just didn't do it effectively enough. And same every time, that's the argument.
Right.
Why might they not come back with something even larger stimulus and create another boom of some sort?
Yeah, and that's the thing. They can always make that argument. But I looked at some of the debt buildups over the last three bubbles, and the first was the technology bubble, and this is in terms of where malinvestment shows up. Mm-hmm. It was $1 trillion in telecom debt. Mm-hmm. During the 2007 credit bubble, $10 trillion in mortgage debt. Now, this doubled over a 5-year period. Of course, a lot of that was malinvestment.
Sure.
This time, China, the total debt in China is $25 trillion. The total, and that's up. That's gained about $20 trillion just in the last 7 years or so, 7 or 8 years, and apparently up from 1 trillion in 2000.
So it's an exponential growth in funny money and debt.
Right. And it's not just China, but I mean, that gives you an idea when you look at the idea that each of these bubbles has an underlying theme, and you look at what's happening with each bubble is they're going parabolic in terms of the amount of debt. You also see that each bubble, history, as Twain said, history doesn't repeat, it rhymes. And what we're seeing is that not everybody is getting each of these bubbles. They don't just show up and looking exactly the same. They look very, very different. And I think this is what's going on this time as well. Each bubble, the last bubble, really sort of implicated the political class. It was the banks. The banks are the ones that got themselves into trouble. They didn't get into so much trouble. With $1 trillion in telecom debt, the banking system didn't get into a lot of trouble in 2000. It was more of the private sector, and it was more of the public investor, the retail investor, who got into trouble. But in 2007, it was more of the banking system, the Goldmans. Well, of course, Goldman survived, but Merrill and the talk about the political class. How about the government-sponsored enterprises?
Well, for sure, yeah.
Now, this bubble, the government has already basically written a big check to bail everybody out. The problem is that now this bubble, it's really, the last time it was more consumer debt and mortgage debt that was going up. This time it's corporate debt and sovereign debt. And, I think we're reaching the limits in terms of how deep the government's pockets really are. Mm-hmm. It'll be a challenge for them to the next time. I mean, imagine we get another bust, a la 2008, and the people that got bailed out the last time are going back to the government with the tin cup in hand. I mean, the last time we had 70 or 80% of the population was opposed to the bailouts, and can you imagine they did not participate in this recovery? Imagine the backlash that would take place. So I think we're more at the end game, Jay.
Well, you raise a good question. I mean, you're up the food chain here, and who's going to bail out the sovereigns?
Exactly.
I mean, and the sovereigns go down, and we were just talking to Mike Oliver about this. This is a confidence game. The confidence game, he believes that interest rates are going to have started rising already, and are that the Fed, the central banks, are losing control of interest rates. He thinks it's the very early stages of that. I don't know what your thoughts are on that, but if that's the case, and the central banks lose control, and the markets are saying we don't have confidence any longer in this system. So who's going to bail out the sovereigns? There's nobody left. That's the idea, I guess you're talking about.
Exactly. Yeah. And I think it also will present some very interesting short opportunities.
Well, we want to talk to you some more about some of these opportunities and ways to try to protect yourself and if possible, to make some money by through some foresight about markets and what's going to happen and what we think will happen. And I don't know how much time we've only got about 7 or 8 minutes left today. And you and I are going to get together and talk again about some of those more about concrete ways that we can profit from these markets, these impending changes that are taking place, and we're going to be providing that to my listeners at J. Taylor Media next Monday. You and I will do a recording this weekend to discuss those ideas. But as far as we're going right now, then factoring in the lessons of the last 6 years, so it's pretty certain, it seems, that we're getting close, but close is a relative idea. I mean, a relative thing. Is it 6 months, a year, 2 years away, Kevin?
Yeah, and the answer is that I don't know. I mean, that's the best
no one knows.
Answer. And I think maybe one of the lessons that we learned, and we'll get into this when we do our segment on Saturday, Jay, I guess, is that it's not a stock market. It's not it really is a market of stocks, it's a market of businesses and industries. And I think what happens, to borrow Nassim Taleb, the author of Fooled by Randomness, his terms, robustness and fragility, that we go through these cycles, and this is where, during the boom time, this is very Austrian concept. I mean, this is where the sins are committed, and this is the destructive part of the cycle. And what happens is that some companies will drink the Kool-Aid, and and so you have fragility getting into the system. But you could even, it's not just companies. You could look at homeowners. Look at the housing bubble the last time. Not everybody went out and became a real estate mogul and bought 5 houses on credit. Some people took the low interest rates, and they refinanced, and they basically put that money in their pocket, and they saved it, and they were very responsible. So, it really comes down to a lot of sort of sifting through and looking at what types of businesses are good businesses, what types are fragile companies that have drunk the Kool-Aid, and so a lot of it. I think this is a big mistake of just trying to kind of time the market and worry about when is this going to happen, instead of, look, where is it happening? Where are we getting the malinvestment? We're seeing it in certain areas, like, for example, the auto finance area. We talked about the sovereign debt area. Maybe the municipal bond market is not as safe as everybody thinks. Okay, so you have municipal bond insurers that they would be vulnerable. So that's the sort of thing that you look for. But it's not a black and white. Let's just short the market. I think that's a mistake that we made, quite frankly, after 2008, 2009. And where we made our money in 2000, we actually did very, very well in our fund in 2007 before the market collapsed, because this is where you had individual companies in the credit sector already breaking down. Keep in mind, remember the subprime bubble, subprime market. That bubble burst in March of 2007. Well before the broad market peaked. And I think, Jay, what's going on this time, it's very similar. I saw something, had it my notes here, 100 companies, over 100 of the S&P 1500 stocks have fallen more than 50%, and 600 are down more than 25% from the high.
Wow.
Okay, so, even though we're not, the S&P 500 is not down very much, what we're seeing is, in these areas that we've identified as malinvestment and businesses that have taken on a lot of debt, are drinking the Kool-Aid, you're already seeing a tremendous amount of damage. And, as short sellers, that's where the opportunity is. So we try not to get too caught up in the timing and the broad market.
Well, certainly, in looking at this market now, the sentiment, I talk about everybody moving over to one side of the boat. Some of the statistics that you brought to my attention are just absolutely mind-boggling. Looking at the hedge funds, you say there are 8,431 hedge funds, only 17 are in a short position. I mean, that's unbelievable. That's almost nobody. Absolutely everybody. It's not just a few people drinking the Kool-Aid. Everybody seems to be drinking the Federal Reserve's and the Federal Reserve's Keynesian Kool-Aid.
Yeah, absolutely. And there was an article in actually where I got that statistic, Jay, was there was an article in the New York Times in June 22nd of this year, and the title was "The Loneliness of the Short Seller." and it talked about money that was flowing out of short-biased funds. And, of course, this has been probably, other than the precious metals area, it's been the worst space in terms of mutual funds and probably hedge funds as well over the last 5 years. But the article talked about just how difficult it is to be a short seller today. And, there's a certain contrarianness to the markets. And, when I remember, I'll give you an example. Mark Faber talked about 1981, I believe. This was when bond yields were at 15%, and everybody was talking about inflation, and that the bond market, Treasury bonds, were called instruments of confiscation. And he was giving a breakout session at one of these conferences, basically as being bullish on bonds. And he said, in the next door, I think it was probably they were talking about gold or tangible assets, standing room only. He had one person show up.
Yeah.
So,
well, that's the way it is. And Kevin, we're running out of time here, but I just have to say that it seems to me it makes for a very volatile environment. I mean, everybody's on one side, but when things change, they could change very, very rapidly. I remember, my friend David Tice going on television, taking a bearish position, before the last collapse. And so, you're out there doing this, and I want to applaud you and thank you very much for coming on the show today. We just are out of time, unfortunately, but we will be talking to you some more. We'll be recording something this weekend, helping people to understand how they can best position themselves for the difficulties that are arising ahead. I want to thank you so much for being with me today, Kevin, and I'll talk to you again this weekend. And pass that on to our listeners on Monday, most likely, at jtaylormedia.com. jtaylormedia.com. Go to the podcast button to hear what Kevin has to say about the application of his comments today. Thank you very much for being with me, Kevin.